Whether you acquire a pre-owned Cessna for $5 million or a new Bombardier for $75 million, the initial wire transfer is the baseline cost of entering the game. This $65 million price tag represents the starting point, a figure that often dwarfs the initial liquid budget of the buyer. Elite investors rarely buy these machines for the cabin service alone. The real motivation is found in a massive provision tucked into the federal tax code. In the year 2026, the government reinstated 100% bonus depreciation. This allows a taxpayer who acquires a qualified aircraft to immediately deduct the entire purchase price in the first year. For individuals with high business income, this creates a colossal upfront tax shield. It improves immediate cash flow and effectively makes the tax authority a silent partner in the owner's travel. These multi-million-dollar write-offs come with specific, mandatory conditions. The aircraft must pass the Section 280F test, which requires the jet to be used for qualified business purposes more than 50% of the time. If the business use falls below that threshold in a future year, the IRS triggers a depreciation recapture. The owner is forced to pay back the excess tax benefit, which is then taxed as ordinary income. Compliance is actively monitored. The IRS now uses automated flight tracking software to audit the stated purpose of every trip. Meticulous flight logging is the only protection against these liabilities. When managed correctly, the jet functions as a regulated business asset, a literal time machine designed to maximize executive output. The financial bleeding begins immediately upon delivery. Effective management requires categorizing costs into 3 groups: fixed, variable, and periodic. Fixed costs include pilot salaries, insurance premiums, and hangar fees. These expenses remain constant even if the plane never leaves the ground. Variable costs are tied to flight time. Fuel is the primary expense in this category, accounting for roughly 30% of hourly operating costs. Periodic costs represent the most significant threat to the budget. These are massive, scheduled outlays for heavy maintenance. A mid-sized jet requires a heavy 120-month inspection. This mandatory process grounds the aircraft for 8 weeks and can cost $1.2 million. Overhauling the engine on a typical mid-sized jet adds another $1.6 million per engine to the bill. This 10-year maintenance cliff is the reason many fleet providers sell their aircraft at the 5-year mark. It allows them to exit the asset while its resale appeal remains high. How do owners absorb these costs legally? They transform their private jets into commercial enterprises. The Federal Aviation Administration has 2 distinct operating standards. Part 91 is for private, owner-operated flights, where no compensation is received. Under these rules, the owner absorbs 100% of the operating costs. To mitigate the financial drain, an owner can place the jet on a Part 135 commercial certificate. This allows them to sell flight hours on the global charter market. This transition turns a financial liability into a revenue-generating asset, offsetting the daily bleed of ownership. Owners typically pair this with professional management firms. These companies negotiate wholesale fuel discounts, often saving 20 to 30% compared to retail prices. There is a silent wealth killer that outpaces both fuel and maintenance costs: depreciation. A brand new aircraft loses approximately 35% of its purchase price within the first 60 months of operation. This chart shows the severity of that decline. A jet purchased for $20 million can lose $2 million in value within its first year. This non-cash expense is the primary financial burden of ownership. The only way to slow this loss is by maintaining meticulous digital maintenance records from a reputable management firm. Considering depreciation and million-dollar overhauls, how can this investment ever be justified? The profit potential is not found on the aircraft's own balance sheet. The return on investment is found in the increased operational efficiency of the business that owns the jet. This timeline shows the practical result. An executive can conduct business in 3 different cities in a single day, a feat that is physically impossible using commercial airline schedules. This logistical advantage is why companies on lists of the world's most innovative firms are the primary users of private aviation. They deploy these aircraft to maintain a physical presence in global markets that standard travel infrastructure cannot support.